You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music means we are back. It is Thursday. Time to talk about some futures options. Yes, it is time once again for TWIFO. My name, of course, Mark Longo from theoptionsinsider.com. Hope you're having a good trading week. Another tumultuous one out there. A lot to talk about. Remember, if you want to keep the conversation going after shows like Vol Views go off the air, you want to join us for Options Oddities, you want to join us for Pro Q&As, you want to get early access to a lot of good stuff, like I am heading down to the OIC conference next week. All of those conversations will hit the Pro tape first, as well as, of course, giveaways. It's coming up on time to give away the April Pro Trading Crate. Where do you get all of that good stuff out there, listeners? Only one place to get it. theoptionsinsider.com/pro is the place to go to learn more. As we learn who's joining us on the old CME hot seat this week, I'm pleased to welcome back our old pal. It's been a little while since he joined us. It's been almost actually, it's been 2 years. It's been since April of 2023. Can that be possible? Since the last time we've chatted with our good buddy, Mr. Erik Norland, the senior economist over there at CME Group. Erik, welcome back to the show. What's going on? Are they hiding you from me, sir?
Well, I don't know. I just can't believe it's been that long. I mean, how could 2 years have gone by?
That seems
but anyway,
insane.
I guess they have. But I'm happy to be back.
All right, Erik, we have a lot to catch up on. 2 years in the market. All right. It's time to get going then, listeners, with a little bit of the old movers and shakers report.
It's time to find out what's rallying on the light side and falling to the dark side at CME Group this week. It's time for the Movers and Shakers Report.
All right, everyone, welcome to the Movers and Shakers Report, the portion of the show where we break down everything lighting it up to the light side and to the dark side over there at CME Group this week. And I'm going to get to all that fun in a second. But it's been an eternity since the last time we chatted with Erik on the show. Don't worry, Erik, I won't make you break down the entirety of the last 2 years since the last time we spoke. But that said, it has been a wild start to the year. You actually posted an interesting blog right before Inauguration Day this year, January 15th, talking about 5 macro factors to monitor coming into the new year. You talked about things like signs of a slowing labor market. We're seeing some interesting data on that front right now. Strained household finances. That one's looking pretty prescient right now. Consumer confidence kind of near some new all-time lows. Lower options prices across most asset classes. We have seen vol obviously spike up and now actually start to come back down since you wrote this. So a lot's happened since January 15th. So let's start there, Erik. It's obviously been a wild year. Give us your thoughts on just the general tumult we've seen in the last few months in the broad markets. And also, how are your 5 macro factors from January? How are they holding up right now?
Well, back in January, I was worried that implied volatility across a whole range of assets was just trading too low. And it was going to go up for a whole variety of reasons. Some of which I anticipated, like the fact that inflation rates aren't really coming down as quickly as we would like. And that, consumer finances were strained, and a lot of things I didn't anticipate, like the pace of public policy changes that we've seen in the U.S. and the responses to other countries that have caused that volatility to spike, and as you say, also now come back down in the last, say, 3 weeks or so. But I think you're right. So consumer confidence here has taken a real dip. I would warn you, however, that there's a big difference between what consumers say about their confidence level and how they actually behave in real life. So far, consumer spending has been holding up a lot better than consumer confidence. Inflation has come down by some measures, but we just got the GDP report yesterday, and the GDP's very comprehensive measures of inflation show that it was actually much more robust than expected during the first quarter, which sent the bond market and the equity market down early in yesterday's trading. But then, of course, they both recovered. But now the bond market's having a big sell-off again today, and so I'd say it's been overall a pretty surprising year in a way. So some things I expected, but then other things that, for me, kind of came out of left field.
Erik, are you saying people lie, consumers lie in those surveys? I'm stunned, sir. I'm appalled that you would make such an accusation, sir. So just can't believe.
Well, I wouldn't say that they're lying, but the thing is, they may not feel confident about how things are going. But at the same time, so long as they're still collecting their paychecks, they have a lot of needs. You have to pay your rent, you have to buy groceries, you probably have to occasionally, replace appliances or get a new car every so often, go on vacation, pay school fees or whatever sort of expense you might be facing. So it's not so much that people are dishonest. It's just that so long as they're being paid, they continue to spend money.
They're not so concerned when they put the credit card down. They're still paying when it comes to all that fun. Let's see what kind of fun we're having in the old movers and shakers this week. And if you see this chart, and we do tweet it out before showtime, folks at CME do as well, listeners, you could see we are hanging out in almost an exactly evenly split market. Haven't seen this in some time. Roughly 50-50 green over red this week. That said, the largest percentage mover is going to the light side, so we'll keep things optimistic. We'll start there, listeners. Number 5 to the light side this week, we got our old pal, the NASDAQ, having a good run this week, up 3.64%. It was number 3 in the same direction last week, up 4.81%. So been a good couple of weeks to be in the tech-heavy NASDAQ. Number 4, speaking of tech, it's the tech sector, up 4.56%. That is of the S&P, of course. That was number 2 in the same direction last week, up 5.89%. So spoiler alert, tech having a good couple of weeks coming into the start of really Mag 7 earnings week. That is, of course, lifting a lot of this right now. But what's not lifting this is just moving on its own. Once again, is Bitcoin. We're going to have some fun conversations about crypto, I think, in a little bit. Bitcoin up 4.64%. It was number 1 to the light side last week, up 9.86%. This resurgence in Bitcoin and crypto has a lot of you folks scratching your heads, so interesting data there as well. Number 2, out to the land of dairy we go. It's Class 3 milk, up 5.38%. And the big dog this week, listeners, the largest percentage mover on the board over there at CME this week, our old pal Nat Gas, resurging, up 16.83%. It was number one in the other direction last week, off 9.71%. So just in case you thought coming into the start of summer, late spring, you thought nat gas might be kind of boring. Nope. There you go, listeners. Dominating the tape in both directions over the past couple of weeks. All right, to the dark side we go, listeners. Number 5, it's silver. Don't tell Uncle Mike silver giving up some of its upside of late, off 3.89%. The struggles of silver versus some of the other metals has been an interesting discussion point. Might get to that a little bit later as well. Keeping it in the metals for number 4, it's copper, listeners, off 5.57%. Then we switch gears to energy, listeners. It's heating oil, off 6.59%. Keeping it in energy for the rest of our bottom 5 listeners. Number 2, it's WTI, off also 6.59%, a rare tie in our movers and shakers this week. WTI, by the way, was number 5 in the same direction last week, off 2.77%. And the big dog to the dark side this week, as you will see, roughly half of the percentage mover that we had to the upside in nat gas, it's Brent, off 7.56%. All right, listeners, now it's time for the CVol movers and shakers. Let's dive right into it this week. Not a lot of time to waste. And vol, again, a bit of a mixed bag. Some of them are popping. Some of them are falling off a cliff. Let's find out which is which. Let's kick it off in the energy CVol, listeners. 63.79 right now, up exactly 2 points on the day. So energy vol popping. When we get to energy a little bit later on the show, we'll probably see why. That is the high for the week, the low 59.16, so a wide range on the week for energy vol. Coming in right below it, we have the aggregate commodities CVol, about a 41 right now, up almost a full point, about 0.9 points just today. That is also the high for the week, so 2 for 2 now, pinning the needle to the upside on the CVol front. The low was 39.16 earlier this week. Below it, are we 3 for 3? The answer is yes. The ag products CVol, 19.69 right now, up 0.53 today. That is the high for the week. The low, 18.63, so over a point range in the ag products CVol this week. So all of you have been saying ags have been left behind on this trade war. The CVol would beg to differ. Below that, we have the Treasury price vol, 7.8 today, kind of unched on the day right now. On the week, though, it's had a hell of a range. That is the high for the week, the low 7.38, so almost exactly a half point range in Treasury price vol. You know, if you've been watching Treasuries for a while, they don't tend to move a half a point in vol every week. So that's a pretty big move, especially when you're starting from a baseline of around 7 points. Below it, we have the FX CVol, 10.53, off about a quarter of a point today. The range for the week, that is pretty much the low for the week, the high 10.88, so FX vol going the other way, pinning the needle to the downside right now. What about metals? Metals right below it, listeners. The metals CVol, 22.32, off 0.61 just today. So metals vol crashing back to earth today. That is also the low level for the week. The high, 25.32. So exactly a 3-point range for metals vol this week. Again, that's a big range for metals, so we'll keep an eye on that complex. And then bringing up the rear this week, we have the Treasury yield vol, 142.04, off 1 3/4 points just today, hanging out towards the upper end of its range for the week. The range for the week, listeners, 134.58 to the downside, 143 3/4 to the upside. Obviously hanging out right now close to that upper band at 142. Pretty much even out there, listeners. And that's your CVol report for this week. But now we can't bury the lead anymore. Erik's been crunching a lot of great data. We want to get to it. Let's kick things off in the rates.
The Fed, the yield curve, inflation fears. How are they impacting options activity and volatility in your favorite interest rate products? Let's find out as we explore the world of rates.
All right, listeners, welcome to the world of rates. You know where to find this in your drop down. Head on over to cmegroup.com/TWIFO. Then go into that asset class drop down. You're going to see interest rates pretty much one from the bottom. It's not rates, it's interest rates. So look for the I. It is an alpha order list after all. And rates have been very much, the entire rates complex been very much in the crosshairs right now. You put out an interesting piece about this just this week, Erik. So very fresh off the research machine over there at CME, a piece entitled Credit Futures, the risk returns of investment grade and high yield bonds, kind of breaking down some of the similarities and differences between the high yield and the investment grade stuff, and also how some of the correlations have been playing out over there as well. So some interesting takeaways, perhaps some surprises. Erik, what have you found out there on the credit futures front this week?
I think one of the most surprising things is that investment grade bonds in general are more volatile than high yield bonds, which I know is incredibly counterintuitive. But the reason for it is that investment grade bonds tend to have much longer durations. They tend to be issued over periods of, say, 7-10 years. So the average duration in one of those things might be like 6-7 years, where the high yield bonds tend to have much shorter durations. So in a sort of interest rate driven market where the main risk is what U.S. Treasuries are doing, the investment grade bonds tend to be riskier than the high yield bonds, but there are exceptions. And so the exceptions are when there's a really steep sell off in the stock market and you have a widening of spreads. So back in February, I published a separate paper warning that high yield bond spreads were trading extremely tight versus treasuries, and they were not really pricing all of the risk that was stemming from the sharp.
You know what, listeners? The magic of technology. Looks like we just lost him, so I'll see if I can get him back here. He was mid-sentence. All right, Erik, did we get you? Are you back there, sir?
I am back.
Right.
I don't know what happened there, but anyway, yeah.
You got so excited.
Yeah, I was just talking away, and then I was like, wait, is anyone here?
You were mid-sentence. We were just breaking down why investment grade bonds are riskier right now than the high yield stuff, which, as you pointed out, highly counterintuitive, sir.
Yeah, and so basically the reason is that the investment grade bonds have a much longer average duration than high yield bonds, something like 7 years versus 3 years or something like that. It's a big difference. So when it's mainly interest rates that are moving or treasuries that are moving in the equity market as, say, stable and spreads are not moving that much, the investment grade ones are more volatile than high yield bonds. But the exception is when there's a really sharp sell-off in the equity market and you see a widening of credit spreads. In that case, the high yield bonds do become riskier and more volatile than their investment grade counterparts. And that has probably been the case for the last month or so, as we've seen a widening and then subsequent re-narrowing of spreads.
Erik, a lot of people have been debating what is really driving this tumult in the markets and also some of the back and forth we're seeing in DC. Some folks point to the equity markets and the returns out there. Other folks are pointing to the treasury markets as being the real tail that is wagging the dog, driving the price action we're seeing in equities, also driving some of the decisions to ease or not to ease coming out of DC. Do you subscribe to that as well right now, Erik? Do you think bonds are the tail that is wagging the dog, sir?
Well, I think the bond market has had some really interesting interactions with the equity market over the last month. There were days, especially between April 2nd and April 9th, in which they were both selling off simultaneously, which is very, very rare, and then days subsequently where they were both rallying. I think there was definitely periods in which higher yields were causing equity investors to go into retreat. But we're seeing a reversal of that today. Today, the stock market is up and yields are sharply higher. And so, the market seems to have gone back to a sort of risk-on environment in the last few days.
All right, listeners, I want to make sure we have enough time to get to all of Erik's hot spots. So I'm just going to do quick hits on the options on all of these complexes. 10-year notes, we're going to hang out, obviously. 2.65 million contracts on the tape, so a decent amount of paper going up this week, as you would expect. Right now, almost half of that, 47% going up. In the June contract has about 22 days to go. The 10-year future, 110 and almost a quarter out there right now, ticking up about 0.25% so far this week. What is the vol in the June 10-year, you might be wondering? A little bit north of a 7.16. That said, up about 1/3 of a point. May not sound like a lot, but In the world of the 10-year, that's actually a pretty large move. Skew-wise, last week we had the calls 5% bid. That has come in now. They're only 2% bid. The puts 3.3% discounted last week. This week, that has come in a little bit as well, down to 2.4% discounted. And the most active contract out there in the 10-year this week, they are the June 113s, putting up nearly 100,000 contracts just by themselves. That in and of themselves, probably more than we're going to see in complexes like silver and many other products we can talk about today. Bitcoin, probably the whole crypto complex, 100,000 just of the 113s going up today, listeners. The big day was actually Tuesday, 45,000, so almost half of that paper going up on Tuesday. Seems like folks were mostly bailing on them. 22,000 on Monday, also closing 20,000 on Wednesday, and then 11,000 today. But even with that, there's still 116,000 left open on this strike, listeners. So folks are still playing in the race, but we have more playing to do with the show. It is time to keep on rolling into our next complex, explore some more cutting-edge research. Let's keep going, listeners, right on into energy.
It's time to tap into the deep options well of black gold, Texas tea, nat gas, and more. It's time to talk energy.
All right, listeners, you know where to go to follow along. Go back to that drop down, pop out of rates. You're going to go up 3 slots to energy. Then we're going to kick things off in crude oil. I know nat gas is moving this week, but we're going to kick things off in crude oil because crude oil, no slouch itself. Brent, number 1 to the dark side this week, and WTI right behind it at number 2. You throw heating oil into the mix. The top of the bottom 5 is all energy related this week, listeners. So a lot going on, and I know, Eric, you and the team have been pretty busy of late, just cranking out video after video after video on the energy markets. We've found a few that have gone up just recently that are kind of interesting, I'm sure, for our audience. First off, just this past week, you posted the 3 major headwinds for crude oil. And then before that, you also pointed out on one of your videos, what's next for crude oil. Now, Eric, doesn't take a genius when you have an administration coming into office who's running on the back of drill, baby, drill. And now we have this global trade war that it seems like the impetus probably going to be to the downside. We have seen a lot of that play out in the markets right now. Let's start there. What do you think are the 3 major headwinds for crude right now? And also, as you point out in your other video, looking ahead a little bit, what do you think is on the docket for crude, sir?
Well, I've been bearish on crude for a while, even before the current administration took power. And so some of the headwinds are really long-term things. So first of all, you have increasing vehicle efficiency. There's a whole bunch of new technologies that are, have been sort of integrating into the automotive industry. So the most obvious one is EVs. Last year in the U.S., for example, 11.5% of the cars sold were EVs. In China, that number was over 50%. But in addition to that, you also have tons and tons of other technologies. Of course, you have hybrids, various sorts of hybrids that have been gaining market share. And then you have even simple things like the gasoline stop-start engine. Like, I don't know if you remember when I grew up, started driving, and you'd stop at the traffic light, the engine would keep running. Now in the overwhelming majority of cars, the engine cuts off until it's time to go again. So all that stuff reduces fuel demand globally by about 2% per year. Per driver, which basically means that around the world we have to drive 2% more each year just to keep demand stable, which brings me to number 2. We've all discovered in the last several years we can work from home at least part of the time, and we can do a lot of online shopping. So the amount of driving people are doing in Europe, the U.S., and China is not much different than it was 6 years ago before the pandemic. And what that means is a lot of these countries are using a lot less fuel than they were, 5 or 6 years ago, because the cars are more efficient and people are driving about the same amount. So all the growth is coming in places like Africa and India, economies that are still developing and growing rapidly, and where these technologies maybe haven't been disseminated quite as much. And then on top of that, you also have the fact that OPEC is, thinking about and is actually beginning to increase production. Which is a big risk, especially for the end of May when OPEC has their next big meeting. If they really do a big production increase, oil prices could fall a long way. And then on top of all of that, of course, you have your very valid points about the new administration liberalizing some drilling restrictions. I actually don't think that the U.S. will necessarily increase its energy production at the current price. However, If prices were to go against my sense of where they're most likely to go, and if they were to go higher, that could incentivize even more oil production in the U.S., which sort of limits oil maybe to the upside, but there's still a lot of potential downside.
Well, I can speak, Eric, as someone who recently got lured into the hybrid fray. It is impressive how much more efficient I am these days. I'm amazed how much of an EV the car actually is. So you're right. If this is writ large on the auto market, then that's definitely going to have an impact on demand. Our chat just pointing out, by the way, Trump just putting sanctions on crude oil today from Iran. That might, in the near term at least, give a little bit of a shot in the arm to crude prices. But right now, the impetus is still to the downside, listeners. WTI coming in right now, 59 and a third, off nearly 4 handles. So again, below that 60 handle. It wasn't that long ago we were talking 70 and definitely 65. If we broke through 65, look out below. We are well below the 65 handle, breaking through the 60 handle. And you know what? WTI options, listeners, are reflecting that right now, putting up the numbers, closing in on 900,000 contracts right now, 867 on the tape. That's pretty spicy for WTI, and nearly half of that, 44% listeners going up in the June contract, has about 14 days to go, so we will hang out there. What is the vol, you might be wondering, in June crude? It is 52.5. Getting spicy out there, up 15 handles this week. So again, I think breaking through that 60 handle has something to do with it. We are seeing a pretty strong bid to the puts out there. Spoiler alert for the skew, so that's also going to lead to that vol ticking up, also showing you which way the options market is pricing in the near term. So interesting. Vol getting spicy. 52 in the June crude, listeners. The puts, as like I said, nearly 12% bid. So I think once we broke through the 60 handle again, a lot of that concern, a lot of that fear, a lot of that interest to the downside, obviously, right now. The call is 7.1% cheap. So I suppose if you are a bull out there, you want to buy some upside. It hasn't been this cheap in a while. Skew-wise, vol-wise, we are ticking up a little bit out there. And if you're wondering what people are trading out there this week, it is the double puts, the 55 puts. So forget 60. That's in the rear view mirror, listeners. 55 strike is where we're looking now. Can we hit a 55 in about exactly 2 weeks? At this rate, we could be there in a couple of days. Nearly 50,000 contracts on the tape this week for the double puts. The big day, actually today, nearly 17,000 going up. 34,000 are open, so they could be closing some of that. But either way, a lot of paper. 16,000 almost yesterday. Looks like closing there, which again, as we're getting towards that strike, not surprising we're seeing some folks taking some of their profits, getting the heck out of Dodge. 9,200 on Tuesday, slightly opening there. 7,500 on Monday. So listeners, are you down for a little bit of those double puts? Let's just look if I can see really quickly if we get some prices for you. Here we go. They're trading for an average price today of $1.38, listeners. So $1.38, 14 days to go. June 55 puts, the future right around 59 and a third. Do you like that as a buy? Would you be more of a seller? Would you be willing to get long some WTI at that level? Maybe collect a $1.32 out there? I'm curious. Hit us up. Let us know. But we have to keep on rolling. Eric is spoiling us with the data this week, listeners, as we roll on out of energy into yet another complex that has been just dominating the headlines and dominating the debates with our listeners. It's the metals. So let's get there next.
Werewolves beware. It's time to explore the options activity in silver, gold, and other shiny things. It's time to talk metals.
All right, listeners, pop on out of energy. You're going to go all the way down to the bottom of the list in the asset class to metals. We're going to go all over the place in the complex because the metals has a lot going on, obviously, right now. We obviously copper very much in the headlines. The big dog also, Eric's got some interesting research on cobalt. We don't talk that really ever on the show, so that'd be kind of interesting. But Eric, we have to start with the big dog, which is gold. What a wild year for gold it has been. Depending on the day and the week, it's somewhere around the number 1 or number 2 gainers for the year when we break down all the asset classes on our futures rundown show. So obviously a good year, even with that pretty epic retreat we saw off of the 3,500 level. We kind of kissed that and then just fell out of bed. Gold coming into the start of the show today around the 3,200 level, 32 and about a third right now. So well off that 3,500 level and still up impressively for the year. So let's start there. Been a lot of debate about gold, Erik, even before we hit these new all-time highs. It's been just a wild asset class. What are the numbers telling you out there in gold right now?
Okay, so basically my take on gold, and I've been very bullish on it, kind of long-term bullish for a long time. First of all, almost every major country is running gigantic budget deficits. In the United States, our budget deficit is over $2 trillion a year. That's like a 7.3% of GDP budget deficit. Here in the UK, where I'm based, 4.5% of GDP. France, 6%. Italy, 7%. Japan, 6%. China is running gigantic budget deficits. So is South Korea. Now the Germans are getting ready to go from small deficits to big deficits. So basically, all of these governments are spending way more money than they're collecting in taxes. Secondly, inflation in most countries outside of China and a few small places like Switzerland is still running above target. Running above target in Europe, the U.S., Japan, Australia, Canada, usually by about 0.5%, 1%, 1.5%. And despite the fact that inflation is running above target, most central banks have been cutting rates. Huge reductions in interest rates by the ECB and its fellow European banks. The Fed was cutting, took 100 basis points off of rates.
The technology gods are not liking Erik today, listeners.
Got me back there?
You got me back again. We just got you in. You're saying the Federal Reserves were cutting rates, and then we lost you.
Yes, the Federal Reserve is widely anticipated to cut rates. Most other central banks have cut interest rates very dramatically. The Fed, of course, already cut 100 basis points last year. So we're running inflation above target. Central banks have been reducing interest rates. And every country is spending huge amounts of money way in excess of taxes, and almost nobody has any plan to deal with this. And that is sort of the perfect environment for a gold rally. And so, yes, of course, no gold rally is going to go up in a straight line. There can be corrections. Corrections in any bull market can be very steep, as we have seen in the last several days. But still, gold is trading up 100% versus where it was a couple years ago when it was down to 1,600.
So are you a believer that we could retest that 3,500 a little bit north of that level, or have we maybe seen the top for at least the near term, sir?
We may have seen the top for the very near term, but the problem is, I guess it depends on what the definition of near term is. It would not surprise me if we challenge or break that by the end of the year.
It's fascinating because back in the big market sell-off and the ramp up of inflation back in 2022, people were a little bit underwhelmed by the performance of gold. It didn't really live up to the hype. A lot of people pivoted into other asset classes as a result. If you were long gold as your inflation or market hedge that year, you did pretty bad. So it's interesting to see gold leaping to life this year and really making up for lost time out there, listeners. I'll crunch some data really quickly because we have a lot of metals to get to. Gold, like we said right now, 32 and about a third. Doing decent paper this week, about what we'd expect, 261 on the tape, so a little bit north of 250,000 contracts. So not lighting the world on fire this week, which is kind of interesting. Maybe the gold bugs, they only like it if it goes up, listeners. The big dog out there this week, by the way, about 37% of it going up in the June contract, has about 26 days to go. Gold vol in June, 1982. Great year, interesting vol level, off about 0.8 this week. And then 3,500 calls are leading the dance this week, listeners, with about 7,000, almost 8,000 contracts on the tape here in gold, listeners. But Erik, I want to get your thoughts on another big metal that has been in the headlines a lot of late. Whenever we talk copper, you can't really leave out the other C word, which is China. Those two things really move in lockstep, it seems like, these days. What's catching your eye, and what are some of your thoughts on what we're seeing right now in the copper markets?
Yeah, so copper used to be very closely connected to crude oil and to China. And so when China was growing quickly or crude oil prices were high, copper prices tended to be high or on an uptrend. And that relationship started to break down about 2.5 years ago, right around the time that the U.S. passed the Inflation Reduction Act, which allowed for huge new investments in electric vehicle recharging stations and investments in the U.S. electric grid, and around the time that China started ramping up sales and production of EVs to 35% of cars sold in 2023 and then over 50% in 2024. And so this has created gigantic new demand for copper. Another new source of demand for copper has been data centers. With the advent of generative AI, we've seen a huge uptick in electrical demand from data centers. So back in 2018, data centers used maybe about 1.9% of electricity. By last year, that was going north of 4%, and by 2028, that could be anywhere from 7 to 12%. So that means there's a lot of demand for copper for the use of electrical transmission as well as in EVs. And so its correlation with crude oil and with Chinese growth is completely broken down. The other thing about copper that's made it a big winner over the last several years, certainly not in the last few weeks and certainly not yesterday, but it's made it kind of that's contributed to the bull market is the fact that mining supply is growing at a snail's pace, way slower than mining supply in iron ore or aluminum or steel or a whole bunch of other metals. Certainly very slow compared to lithium or cobalt, which is growing in leaps and bounds. And it's really difficult to bring a new copper mine online. Generally, from the time you decide you want to start the permitting process to the time it starts producing, you could be looking at 17, 18, 19 years to get it online. And once you've got the permits in hand, it could take maybe 4 or 5 years to get it online. So the prospects for rapid growth in copper supply have not really been there, even though mining it is extraordinarily profitable and the price is way, way above the cost of production.
Well, you mentioned another C word that we don't really ever have a chance to get to on the show. So I want to make sure we talk about it now, because you did some interesting research on the supply risks and demand drivers for cobalt. Yes, cobalt. Forget about copper, listeners. Kick that to the curb. We got another CO metal we're going to talk about here. Unfortunately, we don't get to talk about on the show ever, really, because it's predominantly a futures product. There's no real options market to speak of out there. But cobalt, a fascinating product, not one we get into very often. That's why I like when you get a chance to join us, Erik. You get to bring us to some lesser heralded areas of the market. As you put it here, what are the key upside and downside risks right now for cobalt, sir?
Yeah, so for cobalt, the issue has been just massive growth in supply. Same thing for lithium. Lithium and cobalt are sort of close cousins in the battery metals complex. And so their prices peaked out in 2021 and 2022 and then have fallen enormously. But over the last 2 months or so, there's been a big rise in cobalt prices because the Democratic Republic of Congo, which is the main producer of it, which produces maybe 75 or 74% of the world's cobalt, has put in export restrictions in order to boost prices from their extremely depressed levels. So cobalt prices have jumped maybe 40 or 50% over the last few months, but they are still really low compared to where they were several years ago. And so the difference between something like cobalt and something like copper is that cobalt mining supply has been soaring. And same thing is true to an even greater extent for lithium.
All right, listeners, I wish I could parse some options flow for cobalt, but there is none, and we don't have the time anyway. We have to keep on rolling, getting into yet another hot segment a lot of you have questions about. Let's keep on rolling into crypto.
It's time to explore the volatile world of Bitcoin, Ether, and more. It's time to talk about crypto.
All right, listeners, to the world of crypto we go. It's an alpha order list, so you're going to pop out of metals, go pretty much all the way to the top of the list. One below ags, you will find cryptocurrency. And Erik, it's been so long since we've talked with you that we have a chance to talk about some new products. CME has launched new products in the crypto space since the last time we chatted, including the hotly anticipated Solana future. I don't think you and I have ever talked about Solana, so I think that'll be interesting. What are your thoughts about the Solana future and the Solana market in general? And then B, I know you've been crunching a lot of numbers out there about what's next for the entire crypto complex, Bitcoin, Ether, and Solana, and also some of the similarities and differences you're seeing between that new Solana future and the other, shall we say, more mature crypto markets of Bitcoin and Ether, sir.
Yeah, so it is an exciting new future, and basically Solana, in my mind, is more similar to Ether than it is to Bitcoin, in a sense that it is kind of used for real applications, unlike Bitcoin, and can be used to create smart contracts and other sorts of applications. It's used a lot in the development of games, et cetera. So it has a lot of real life applications, and it has a growing user network. It's also a very energy efficient currency, and it can do a very, very large number of transactions per second, something like 65,000 transactions per second on the Solana blockchain, which is about twice what can be done on Ether, and about 10,000 times it can be done on Bitcoin, whose blockchain it can only do something like 7 transactions per second on the actual Bitcoin blockchain itself, not the future on the Bitcoin reference rate, but the Solana prices, along with Ether, have corrected a bit this year. They have rebounded a little bit in the last few weeks. Same thing, of course, is true for Bitcoin, which has found some new life. But kind of my research in the complex in general shows that all three of these are positively correlated with the NASDAQ 100. So they are something you might want to look at side by side with the NASDAQ future and NASDAQ options. That they tend to have a weak correlation with gold, but the correlation is usually a little bit positive. So, just like central banks can't print gold, and governments can't sort of create gold to fund budget deficits, they also can't do that with cryptocurrencies. So they also have a sort of gold-like aspect to them as well. They tend to, as such, have a negative correlation, a kind of weak and not necessarily very stable negative correlation with the U.S. dollar as well. I think that's sort of the thrust of the research. The last thing I'd mention is that Bitcoin had been increasing in price sort of in general at a pretty fast pace for its first decade of existence. But for some reason, those price increases seem to have kind of lost momentum. I know it's had a good couple weeks here, back up above 90,000. But it's kind of interesting that, Bitcoin did not break to new record highs like gold did. So people are treating it differently. It's sort of, again, a hybrid between an asset like gold that central banks can't create, but something that's still closely connected to the technology industry, whose stocks suffered quite a sharp correction over the last few weeks before hitting bottom about 3 weeks ago.
I'm so glad you brought up correlation, because that is the hot debate yet again. It seemed like we had maybe settled that a little while ago, Eric. As you point out, is correlated to the NASDAQ 100. A lot of people have viewed Bitcoin in particular, you could argue some of the others as well, as having a decently high beta to high-tech stocks, so you could see it as a bit of a high-tech allocation. It also seemed like the dagger had been put in the heart of Bitcoin as digital gold, going back to those markets I talked about a few years ago, where Bitcoin didn't really perform like you would expect a digital gold asset to perform. So that seemed like that kind of cut the legs out from underneath that market. Now coming into this year, we're seeing a hot debate on that again, Eric. All of a sudden, we're seeing people saying maybe it isn't the high-tech asset or the high-tech correlation that we thought. Maybe it is more along the lines of gold. Sounds like your data is still saying the opposite, Eric. At the end of the day, maybe more of a high-tech allocation, less of a digital gold allocation, Eric.
Yeah, I think so, but I would still say it's a little bit of a hybrid. It's got characteristics of both, which makes it something very, very unique and very different.
I think that's a key portion of this as well, because the Bitcoin correlation in particular, and all of crypto to a degree, it seems to ebb and flow month by month. And what it's correlating to this month may be different than what it was correlating to last month. So it does seem like there is a lot of evolution in that conversation as well, which maybe at the end of the day does go back to what people were arguing a decade plus ago, Eric, that it's uncorrelated. It's its own thing. So I think there still is a lot of data to be crunched on that front. Speaking of the crypto front, a lot of people have been flummoxed in our audience in particular, Eric, by the recent resurgence in Bitcoin. Again, kind of going back to throwing cold water on some of that tech allocation or that tech correlation we've seen between Bitcoin and the leading crypto assets and the high tech names and the equity markets. Typically, when it all hit the fan in the equity markets, correlation would tend to go to 1. It would drag everything down with it. We saw Bitcoin and a lot of major crypto assets rallying even in the face of some fairly aggressive sell-offs recently in the equity market, which again surprised a lot of people and also once again brought to the fore this argument about what the heck does this stuff actually correlate to? Eric, what were your thoughts on maybe some of those surprising movements and indeed the equally surprising resurgence we've seen of late in Bitcoin, even if, as you point out, it didn't quite make a new all-time high like gold did?
Yeah, I mean, I think again, it's an asset that central banks can't create. So, as inflation remains stubborn and central banks are cutting interest rates, and so many countries, from China to the U.S. to countries in Western Europe and Japan, are running these gigantic budget deficits. People really are looking to hard assets that central banks can't create. And so, if you're looking at gold, and you could also look at silver in that regard, you may want to expand the horizon and also look at cryptocurrencies. All of these things are things that central banks and governments can't print.
They can't print them, but they can hoard them, Eric. There we go. Right like clockwork, listeners. We lost him again. Let's see if I can get him back one final time here, listeners. All right, Mr. Eric, as we were winding down. Again. Right as we were winding down. I did have one last question for you. You did mention we obviously can't print crypto assets, but we can hoard them. Since the last time you and I chatted, of course, this debate has raged about whether we should have a crypto reserve. Obviously, a hot topic in the U.S., the administration coming in on it. Our audience, a little bit more negative on it than you might expect, which is kind of interesting. Where do you fall on that debate? Is that the answer? Should we hoard them?
Well, the thing is, the supply of Bitcoin is so limited. There's only ever going to be 21 million coins, of which 19.5 million already exist, and some portion of that have been lost. So I don't know that it would be a good idea for the government to use taxpayer money to go into these markets and buy the coins. However, what the administration has proposed is that in cases in which criminals forfeit crypto assets, those could be held in reserve. Now, I think that's probably fairly small quantities, maybe not enough to really permanently lift prices, but that might not be a bad idea, but I don't think it's a major game changer for the government or for the markets.
Well, Eric, I appreciate you joining us from across the pond. Technology gods be damned, sir. But before they strike you down again, really quickly at the end of the show here, if there's any complexes or any research you have that we haven't had a chance to talk about yet that you want to make sure you address with our audience, have at it, sir. The floor is yours.
Well, I think one thing that's very interesting now is look at what's going on with the U.S. dollar. The dollar had a big sell-off in April, but it seems like maybe it's hit bottom and maybe could start rebounding. It's already rebounding today pretty sharply versus the yen and some other currencies. The U.S. dollar might be oversold here, so that would be a whole interesting complex to look at.
All right, Eric, and if you also want to leave us with a little bit of a hint, a little bit of a tease of any other research you and the team over there at CME have up your sleeve, go ahead. Any teases you want to leave us with?
Well, I think we're going to be publishing more on gold in coming weeks because we just got this is very exciting if you're a gold bug, the CPM Gold Yearbook, which basically gives you all the supply numbers. So we know what drives gold demand, but you can't forget about the supply. And the supply of gold is just not growing very quickly, much like copper. It's pretty stagnant. So there's not a lot of new mining supply for it. So I think that's going to be an interesting avenue for research. I think there'll be a lot more written about crypto in coming weeks as well.
All right, Eric. And if folks want to check out all this great research we talked about already today, where should they go? What should they do, sir?
They can look at cmegroup.com. It's all on our website, also available via the app.
There you go. Check them out, cmegroup.com. While you're there, listeners, you know what to do. Head on over to cmegroup.com/TWIFO. Make sure you save some time for that. You can check out all the data we didn't have a chance to get to on the show today because Eric brought such great data to the table. Well, Eric, again, I appreciate you joining us, and we'll definitely have to make sure we bring you back on more frequently than once every 2 years, sir. There's a lot going on in these markets we need to talk about.
Yes, I'd love to come back, and I'll try to write more on vol and implied volatility, too, and hopefully that'll be a good excuse to get back on the program.
Hey, we could just talk all Cobalt for the full hour if you want, Eric. We'll mix it up. Have a lot of fun. But I appreciate you joining us, listeners. That music means that's going to do it for us on the network today. Back again tomorrow, noon Central, 1 p.m. Eastern, to talk all things vol. We have some great guests. A good buddy, Dr. Vix, Mr. Matt from Orats, and other special guests will be joining us. Another wild week on the vol front, so stay tuned for that. And then coming right after that, immediately on the heels for all of our pro members, I'll be joined by Mr. Matt to talk a whole bunch of unusual activity on Options Oddities. Listeners, should be a good time. You want to check that out. Trust me, theoptionsinsider.com/pro is the place to go to learn about how to access all of that fun. Then I'm back again on Monday for the option block, then heading down to the OIC conference. But you know what? No rest for the wicked for me next week. So you'll still get your TWIFO on the same bat time, same bat channel, this time next week. Until then, listeners, stay safe out there.
This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.